G'day expats and welcome to another episode of Expat Chat. Episode 79 today, and I'm joined with my co-host Mitchell Kelsey, who is a financial planner here on the Gold Coast with me with an APAC specialty focus. He's also the host of the Atlas Weekly Recap. G'day Mitchell, how you going?
Hey James, doing well, mate. Another
Way.
beautiful sunny day here on the Gold Coast. How are you
I know
doing?
we Oh well, mate, you're right. We've been pretty lucky with the weather today. Those that have been tuning in this week's been pretty miserable on the Gold Coast. I think we came in yesterday and it was like the sun didn't really get up, to be honest. It was like it was 6 p.m. all day. It was a bit strange.
Yeah.
But Mitch, I want to kick it over to you and I want you to just give our listeners a bit of an insight into the Atlas Weekly Recap because that's a weekly podcast that you've been doing now and it comes out every Friday. Give us a bit of an insight into that.
Yeah, that's right. So I've been running the Atlas Weekly Recap for about 2 months now. So I think we're up to episode 10. And effectively, it's just covering the main events of the week that's just been that might impact on investors. So how these sort of economic events impact on equity markets, currency, debt markets, things like that. Just sort of keeping investors in the know of what's been happening and how that might impact on their investments.
Yeah, that's right. Yeah, exactly right. It's been great. I mean, I tune in probably every sort of, or listen to it maybe Friday evening because it does just give us a bit of a recap of all the big movements. I mean, everyone that's probably been keeping an eye on the banking sector, especially over in Europe and the US. So there's a couple of good episodes there. But mate, I guess the next couple of weeks are going to be pretty busy, especially with next week we get that RBA decision. I wonder if they're going to pause or not.
Yeah.
Should be very interesting. But what I want to talk about today is exit taxes, because
Mm.
it might surprise a lot of our listeners that a lot of countries surprisingly have exit taxes. And funnily enough, Australia is one of them. So before we dive into it, I'll just get rid of that quick disclaimer that we love getting out of the way. So today's episode, it contains general information only, shouldn't be taken or construed or consumed as personal advice for entertainment purposes only. If you do need advice, please reach out to ourselves. We'll be happy to help. But today's episode, only for entertainment purposes only. Let's jump into it. So, I mean, Mitchell, you've obviously had some exposure through exit taxes. I think the main one we always hear about is that US one.
hmm Yeah, probably the most notorious one is the United States. I think in almost like 80% of calls where I'm speaking to an Australian expat who's looking to come back to Australia, who's based in the United States, they're going to ask me, what's his exit tax? Will it apply to me? So that's probably the big one.
Mm.
But yeah, as we've seen, there's another big one in sort of Singapore, but it seems like countries are just beginning to introduce new
Mm.
exit taxes, all the time.
Yeah.
And yeah, it's just sort of to keep up with this I guess theme where a lot of people are becoming a lot more mobile, a lot more global. So they're looking to capture these types of individuals before they leave
Mm.
the country and try and get that last opportunity to tax these individuals. So it's a
That's
very
it.
evolving sort of space for sure.
Absolutely, and I agree with you. It's still it's a form of revenue raising for most federal governments, isn't
Mm,
it, with the ATO? And I mean, we know the US, they've got a big fat hairy exit tax there with that Hard Act and
mhm,
becoming a covered expatriate. But funnily enough, so does Australia. Australia has an exit tax, and it's sort of not necessarily a stealth tax, but it is something that everyone needs to be mindful of when they are leaving Australia. And the main thing there we're sort of talking about is that deemed disposal event. I might
mm.
throw it over to you just to run over. What is deemed disposal generally?
Yeah, so I guess with Australia's exit tax, it applies, I guess, when tax residency status changes. And this deemed disposal event, what it means is effectively at the time that an Australian departs Australia, they have those intentions to move overseas on a more permanent basis. They are deemed to have disposed all of the assets that are not considered taxable Australian property. So taxable Australian property, generally any sort of physical assets. So, a previous main residence and investment
Mm.
property. So those will remain taxable and generally not subject to deemed disposal. But all these other more, I guess, movable assets, so shares, cryptocurrency,
Yep.
ETFs, these types of assets, non-tap assets.
Mm.
That's what this deemed disposal sort of is referring to. And you're effectively deemed to have disposed of these assets at the time of becoming a non-resident.
Yep.
But I suppose what's interesting with Australia's exit tax is you can defer it, right? So you can opt out. So you don't necessarily have to pay the tax, and you can just look to continue to accumulate that capital gains tax liability on those non-tap assets.
That's
So it
right.
works a little bit interestingly.
Well, that's right, and you're right, and you don't have to opt into the deemed disposal event. And probably the only consideration that we see time and time again with a lot of our clients and expats is, okay, well, what does that mean when I actually want to sell those shares, but I'm overseas for 4 or 5 years? I think a lot of people forget that they still have to pay tax or capital gains tax to the ATO. And the main drawback that we often see is that period that they've been overseas for the non-residency. As you know, we can't discount that by 50% because now it's treated much like tap assets. And secondly, your tax rates are a lot more punitive because you're a non-resident. So we don't have that tax-free threshold. We're always going to pay minimum tax at 32.5%. So you've really got to question whether it's worthwhile. And then taking it as even a step further, often you can't really go back and undo that, the deemed disposal. Oh, shit, I should have gone back and done deemed disposal 5 years ago because all of a sudden this portfolio I've held has just exploded.
Yeah.
And the reason why you can't do that is because generally the commissioner or deputy commissioner of taxation, he'll see that as anti-avoidance. You're trying to avoid paying tax.
Yeah.
So you're trying to obviously go back and amend it. But I mean, there's a laundry list of countries that I guess have punitive exit taxes. And I know the main ones that we run into, funnily enough, Australia is definitely one of them, the deemed disposal.
Yep.
Singapore, as you mentioned before, the US one, that's a beast. Canada is actually very similar to Australia in terms of deemed disposing on shares and those sort of things. Not necessarily physical property, but it really depends on your residency there in Canada. I think probably the main one that, again, we speak to clients about and expats is the US one. Did you just want to run us through what those general tests are for that US exit tax?
Yeah, so with the United States, it's really going to apply to those that are citizens, so those that have US citizenship, or those that are referred to as long-term permanent residents. So generally these individuals have got that green card, they're permanent residents, and they've held that for at least 8 of the last 15 US tax years. So if that's the case and you sort of fall into, you meet one of those sort of eligibility requirements, that's when you could be subject to this exit tax event. And then just purely talking about staying on the United States exit tax. And then once if you meet that criteria, you're considered a covered expatriate. And then essentially you're applying 3 additional tests. And if you meet one of these 3 tests, then you may be subject to this, you will likely be subject to this exit tax event. And just giving a quick high-level summary of these 3 tests, I mean, they are very detailed. It's a very detailed piece of US tax legislation. So essentially, if your net assets are greater than net 2 million USD, then you will be subject to this exit tax event. The second test is if your average income tax liability in the United States is, I think it gets indexed each year, but it's generally, I think right now it's about 180,000, which, to put that into context, generally you need to have earned, about 500,000 USD on average over the last 5 years. So that's the second test. I guess the third test is the one that sort of scares most people, and that's this tax compliance test. So you just need to show evidence that you've been compliant in all of your US tax reporting, your information returns, your FBARs, these types of things for the last 5 years.
Yeah.
And effectively, if you don't fall into one of those categories, then you're not going to be you may not be subject to this exit tax event. But again, it's sort of very subjective area.
Yeah, that's right. And I mean, that was a really good summary of it. And I think they brought it in a little while ago, this exit tax, and it was obviously to try and capture out those sort of other high income earners or sort of, people that are considered quite wealthy based on their assets. But as we've seen time and time again, those assets, like in terms of the asset test, you can actually rack them up very easily. If you've got an old property back in
Mm,
Australia that's a main residence, you've owned it for maybe 20 years, it's probably gone up in value, especially if you're in a Melbourne or Sydney market. It includes retirement accounts, superannuation. It
mm,
includes your IRAs, your 401ks. The list is pretty endless, and it's just something to be very mindful of, and plan appropriately. If we kick it over to Singapore, the Singapore exit tax, which I think is a really good one, and I was talking to you just before we started recording, where I had a client last year. Actually, no, I had two clients last year that were captured by this Singapore exit tax, where because their employment was coming to an end, essentially it forces a deemed disposal event on the shares that they hold through their employer, as well as all the sort of shares that are still vesting to them, options, restricted stock units, all those sort of types of different forms of compensation, equity compensation. So remember, because they're still vesting, that means they actually can't do anything with them. They can't sell them. They can't
mm.
access that capital. So they're having to pay tax on something in which they can't actually realize the benefit for another 2 or 3 years. And that's why the Singapore exit tax can be really punitive and can
That's right.
really put you in, I guess, a bit of a unique situation. I'll say this though, the Singapore IRD, they did come out, and if you pay tax, then you can actually go back the following tax years and actually go back and do a tax claim back. So if the
Mhm.
actual share price on the vesting date is less than what it was last year, technically you paid too much tax in that previous year. Whether you're successful in getting tax out of them, like a refund, that remains to be seen. But that's a bit
Mhm.
of an example of, I suppose, the Singapore exit tax. And I mean, Mitchell, with exit tax with the US, I mean, I think you've seen cases where people have sort of relinquished green cards at certain periods just to avoid it, haven't they?
Mm. Yeah, definitely. And it's sort of, I mean, in most cases, it's going to free up a returning expat or someone that was a green card holder or even if someone that is a US citizen when they're returning to Australia.
Mm,
If they do renounce citizenship or return that green card, in most cases, it's going to free up their options here in Australia. So that's sort of the reason why a lot of these individuals do consider it. But
mm,
this US exit tax does sort of act as a bit of a barrier to do that. It might sort of, they might think, oh, it's not worth the exit tax that I might pay by renouncing my
mm,
citizenship. So it sort of acts as a bit of a barrier there. And it's important to know, even with the permanent residents, as individuals that have a permanent residence status or that green card, when you return to Australia, you must physically, submit the correct paperwork to
mm.
abandon, like officially abandon that green card. You can't. It's not a case like, as we know, green cards will generally expire after
That's
a
right.
period of time, and
That's right.
just because it's expired doesn't mean that you're not still subject to the IRS sort of income tax and information reporting
Yep.
requirements.
That's right. And I was reading a really good sort of webinar, I suppose, presentation that was conducted in February. And that was one of the main points that we're really trying to drive home here, where a lot
Mm,
of Australians or a lot of expats in general, they go over there, they maybe win a green card in the lottery, and then they think when they come back and their green card expires, they actually don't legally need to do anything more. But you do. You are actually meant to. You're still a US permanent resident technically, even if your green card has expired. You're still got I suppose, responsibility there to continue up your US tax returns, which can be a bit of a nightmare. And I guess we won't go into all the hurdles that you've got to face with how you should structure your things back in Australia when you're
no.
still connected to the US, because as we know, it's a bit of a minefield. But that's a really good example there. But I know um, in terms of recent sort of client examples, probably Singapore is the one that I've been seeing a lot lately. In terms of that just punitive exit tax, whether that's just been
Mm,
because there's been a few layoffs maybe in some of the tech sectors and those kind of employees that people have been forced back to Australia. But this might actually interest our listeners, that these are the countries which actually have an exit tax, a form of exit tax. So Australia, that's definitely one of them. Canada, Denmark, France, Germany, Norway, Singapore, South Africa, Spain, United States, obviously, Finland and Russia. Finland and Russia, they've only recently come to the party with forming an exit tax. But I wonder if we're going to continue, as you said earlier, start to see a
mm,
bit of a theme here developing, say, going forward, because it is sort of that final opportunity that a country can tax people.
Yeah, definitely. And I think I'm not sure if you mentioned Russia is also Russian and
Mm.
Spain as well. They're looking
Yep,
to sort of introduce one as well. No, Spain's on there already, but there's even more
that's right.
countries looking to be added to the list. And
Mm.
I guess a good topic as well that will come about is employees that are sort of on secondment overseas as part of
Yeah.
their with their employment, that are sort of tax equalized, whereby the employer has sort of agreed that, as part of this
Mm.
secondment overseas, the employer has agreed that we will essentially tax equalization just means that you're not worse off from a tax standpoint by being posted overseas.
Mm.
And whether or not employers are going to cover these exit tax events that their employees are going to be subject to. And historically, they generally employers won't cover their employees, and there's been cases where the employee will, where the employer were, but it's very rare.
I
So
agree.
that'll be an evolving space as more countries are introducing these types of exit taxes, and whether or not an employer is going to foot the tax bill when that employee comes home.
That's right. And it's a really important point you make there, where it essentially means the employer is paying this tax bill on that employee's wealth, essentially,
Mm.
wealth that they might have accrued up until the date that they leave and go, and I can't see too many employers wanting to do that. But it also comes down to education, with one, the employer, two, obviously the employee. A lot of the time, from our experience, we see obviously expats, they're seconded overseas, and they might be given a 3 to 5 page PDF memo from one of the big four accounting
Mm.
firms. I'm not going to put too much shit on them, but unfortunately, you do not get too much advice from them. They go, hey, listen, you're now
Mm.
in the US. You're also in this state. These are the taxes you need to be aware of. Same with Singapore and all the others. But they don't really educate you on this deemed disposal event, whether it's the right thing to do, depending on how long you're going overseas. And I agree, mate. I think employers, I just don't know if they're going to be footing the bill for,
I
I
don't think so,
suppose.
because it's going to be, on their personal assets, right? And that's sort of the argument that employers have been making to date. Like they'll cover the income tax liabilities, but in terms of their own personal assets, it's hard to argue that the employer should pay for those taxes that come about from when that employee departs the country.
That's exactly right, mate. That's exactly right. And I mean, I'm sure there'll be plenty more examples coming out. I mean, in Australia, we get our May budget very soon. Obviously, we're winding out March, and it'll be interesting to see what sort of changes come through on that. I know that we're always keeping an eye on those tax residency changes. Inherently, there maybe could be some more exit taxes. Who knows? I don't think there'll ever
Mm.
be exit tax on, I suppose, physical property, but whether they maybe change deemed disposal and those sort of things, who knows? I want to do a quick shout out as we wind up today's episode. We do have a webinar coming up on Tuesday, the April 25th. It's going to be about 6:30 p.m. Our local time here in Australia, Australian Eastern Standard Time, which will be about 12:30 p.m. I believe on Dubai side as well. And what we're going to be covering in that webinar is we're going to be talking about managing your Australian mortgages. So we'll have Jeremy Harper there. He's the director for the Atlas mortgage side. And then also considerations going forward for property portfolios. I think it's been a really big topic of late, how property's been tracking. So it should be starting about 4:30 p.m. Hong Kong, Singapore time, 6:30 p.m. Sydney time, and 12:30 p.m. Dubai time. Mitchell, it's been terrific having you on today. I think there'll be many more to come. If we get some good feedback from our listeners, ladies and gentlemen, maybe we'll just give Brett the shaft.
No, it's been
Anyways,
great being on again. I think it's been, close to 6 months since I was on those previous episodes. But yeah, thanks again for blogging, the Atlas Weekly Recap. If
mm,
listeners are looking for a bit of a succinct update in terms of what's been happening in markets for the week just been, head over to the Atlas Weekly Recap. And yeah, it's normally 5 to 10 minutes, so it just covers the main events for the week. So yeah, thanks for having me on, James.
no worries, mate. And for those listeners dialing in, I mean, bit of homework, as Brett always likes to give us. If you like the podcast, please feel free to like and share it with your friends and family and other expats at your local barbecues that you're having. We do this for you guys. In the meantime, guys, we'll catch you on the next episode.
Bye, guys.